Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. It is the start of a new trading week, and U.S. equities have opened higher as investors brace for pretty key economic reports through this week. On deck for release is the U.S. CPI, also PPI, and retail sales data. So it's a big week on that front. And then tomorrow, Fed Chair Jerome Powell takes to Capitol Hill for his semi-annual testimony to the lawmakers. Joining us now to unpack the macro themes on his radar this busy week and what it ultimately may mean for you and for all investors is Fidelity Director of Global Macro, Jurrien Timmer. Hi, Jurrien. Great to see you. How are you doing?
Good morning. Nice to see you as well.
So it has been just pulsing with news, and it's almost hard to keep up with on the economic front, on the global front, on the global macro. At some point, where do you sort of find the peace and the calm to take a look at what's driving markets?
Yeah, no, it's a great observation, and the data has just become so fast and furious, or not even the data, but the news flow. That it's almost hard to figure out, like, wait, what did that just happen like last week? It's like it's hard to put it all together. And part of this, I think, is a deliberate political strategy by the incoming administration, that they are creating so much stuff out there that adversaries or anyone doesn't even know sort of what's real and what's not. So I think part of this is by design. But there's just a lot happening, and we're only like 6 weeks into the year. So I find solace in my charts, right? Because when it becomes when it becomes very noisy and the noise to signal ratio goes up, or you don't know where it is, I just go back and to my knitting, if you will, and just look at all the charts and maybe zoom out from very short term to very long term. And what strikes me is that as much has been going on, and as positive as the first month was in terms of that leaderboard that we looked at last week, that everything that I track was up in January, it doesn't really feel that way, right? And if you look at the market, like we can look at slide 2 here, the markets feels kind of like it's churning, right? Like Bitcoin's like stuck at 100,000. The Magnificent Seven are sort of consolidating. They haven't really made a new high since December. The banks are on fire. European banks are strong. Like, go figure that one, right? And so, but there isn't. There's just a lot of noise right now. And so unpacking that, like if we go to slide 3, we look at the S&P 500 cap weighted index, which of course is the index that we all look at. That still looks fine, right? Rising trend line. We're above the trend line. We're making higher highs, higher lows. So that on the surface is fine. But then you look at the breadth numbers below. Percentage of stocks above their 200-day moving average, is only at 62%, and making lower highs. And there, market history shows that there's a lot of false alarms on these breadth divergences. But you can see historically when the market becomes more mature, breadth tends to contribute less. And so, and again, I'm not saying we're at the end of a bull market or anything like that, but it's, as a technician who studies history, that's one thing that I observe. And of course, last year at the beginning, we were talking about the markets finally making new highs, and how that tends to create momentum, and that it was a bullish broadening. And so we're now a year later, hard to believe it's already a year later. And so we are feeling a little bit more like a mature bull market. And just to show you one more on slide 4, this is the equal weighted index, and that's actually at a lower high, which doesn't necessarily mean anything yet, because that could be resolved tomorrow, basically. But if you look at the bottom panel, that's the percentage of stock above their 50-day moving average. So that's a shorter measure of how many stocks are participating. And one thing we know, that if you're in a strong bull market and you've had a correction, it tends to come roaring back. And what we're seeing right now is we've only had a minor correction, 5% earlier this year. And at that point, only 17% of the stocks in the S&P were above their 50-day moving average. And now we're at 53, which is not terrible, but it's not great either. And again, there's not necessarily a signal here, but these are things that I'm keeping an eye on, like because if this market has a lot of momentum, these oversold conditions get corrected very, very quickly. And you saw that, for instance, in October of 23 in that chart, we went from 10 to 90 like in a heartbeat, right? So maybe that will all happen in the coming weeks, but these are the kinds of things that I'm trying to look at to anchor myself in, okay, there's all this noise, but what is actually happening in the markets?
Well, it's interesting. Show us some of your sentiment indicators, because my initial sort of response to that is, well, for instance, is it pricing in an overhang of a tariff story, of a global macro story, just holding, just waiting to see? But then again, what is sentiment telling you right now?
Yeah, so if we go to slide 6, and that could be part of the story, right? That um, if you look at the flows into the U.S. equity market, they're very robust. So you could argue that investors are poised for a bull market, which of course we're in. But maybe that's one reason why the breadth numbers haven't come roaring back as fast as they normally do, because maybe there are not a lot of buyers left to buy, right? And then we were talking in the pre-show about like the supposed layoffs that are happening in the government sector with Elon Musk and his Doge, and what if we start seeing a spike in jobless claims? Because who even knows how many people are actually being laid off, or if anyone's being laid off.
I mean,
But
it sounds bad. It sounds like it would
yeah,
be bad for the economy.
yeah.
But as you say,
Um,
you don't really know.
so the market, I think, is kind of priced for perfection, perhaps, and maybe that's why there's not a lot of new money coming in when there is a dip, and it was only a 5% dip. So I don't want to overstate what's happening, but we're in a very strong earnings cycle. Fourth quarter earnings season is almost not quite done. But if we look at slide 5, for instance, the numbers are really good on the earnings front. But
Maybe.
again, is it priced in, right? The PE is high. We know what the story is there. And so I think these are some of the cross currents that investors maybe are, or that I'm struggling with, in terms of, what needs to happen for yet more money, more new money to come in, or has this whole Trump trade already been priced in? My guess is that we're fine, that the cycle continues. You can see here, we got 300 companies reporting so far for the fourth quarter. And, the typical number, three quarters are beating estimates by about 6%. But if you look at that black line there, the growth estimate has jumped 500 basis points since the beginning of earnings season. And that's actually pulling the calendar year number up. If we go to slide 7, you can see that the 2024 number, which had been at 10% the whole year, right, a growth rate of 10%, now is actually up at 11.4. So if you look at the last 4 years of earnings growth, right, 2021 was 48%. That was the recovery from COVID. 2022 was 8%. That was the bear market, but it was entirely a rate-based bear market. Earnings were growing. And then 23, we had a very modest decline of 2.6%. And now 2024 is plus 11.4. And so, that's a really good outcome. But the question is, how much of that was already anticipated with a rising PE that went from 15 in October of 2022 to now 22, right? And so these are always the questions. Price and earnings do not move at the same time. Price always anticipates. And this is always the problem, or the challenge with market timing, is that, it's one thing to know which way the fundamentals are going, earnings, interest rates, but it's another thing to know how much of that has already been priced in, because the market's always ahead.
Yes, and as you say, the valuation story has been well telegraphed, and it was quite astonishing last year. I mean, where valuations have gotten to. You spent time on the earnings there. I wonder if we can just go to some of the macro. There's a certain amount of, it appears the Fed is sort of on hold and did a lot of skirting so that they didn't have to say a whole lot, basically. There is a QT element, though, here that is also policy to tighten things ultimately. Where is that going at this stage?
Yeah, it's interesting. So if we go to slide 9, it's fascinating to me how investors go from obsessing over certain things to being completely complacent about the same thing sometime later, right? So you know this. We've been doing this for, what is it, 4.5 years or something like that? Is it almost 5 years now? Can you believe it? Um, and a year ago, 2 years ago, I mean, the market was so obsessed about how far will the Fed raise rates and when will it stop and when will it start to cut? And of course, all justified. I mean, we were all obsessed about those things. And then the market was pricing in, last fall when we had that little growth scare, market was pricing in the Fed cutting all the way to like a two handle, right? 2.7% or so. The 10-year yield was at 3.7, I believe, at the time. The Fed did end up delivering 100 basis points. And I think that was the right thing to do because if a neutral rate is at 4 and the labor market's back in balance, the inflation rate at least has moderated, although it's proven to be quite sticky in the high twos. But the Fed no longer really needs to be overly restrictive at this point. It shouldn't be accommodative. It shouldn't even maybe be at neutral, but it should be slightly above it while it waits for the inflation data to unfold. So I think the Fed, which is now signaling that it's holding off on any further rate cuts, I think is exactly the right thing to do. And if you look at the dotted line there, that's exactly what the market thinks. The market expects the Fed to go to 4. Maybe that's a little bit ambitious, but it doesn't matter. That's a quarter point. But the market has gone completely from focusing on the short end of the rate structure to the long end, right? Because we have obviously a big fiscal story, and to what degree Elon and Bessent in Treasury are able to cut the deficit, who knows, right? I mean, not very much of the budget is discretionary, maybe 20%. So, but if they can cut that 20% down to 10, I mean, that will make a difference. And so that's what the long end is reacting to, and we'll talk about that in a moment. But you mentioned QT, so the Fed, I think, is done here. The market is totally fine with it. Even the White House tweeted that they're fine with Powell no longer cutting rates, which is quite a change from the first administration. But if we go to the next slide, 10, we can see that the balance sheet reduction is continuing apace. And there are no signs at this point that the Fed is about to stop that. And the reason why this is interesting, because the QT from the Fed really hasn't had any impact on the market over the last couple of years the Fed's balance sheet's down like $2 trillion, right? So we were all thinking a couple of years ago, oh my God, the market will never survive this. But because of these technical components of the reverse repo program and the Treasury's TGA account, the Treasury General Account, which is essentially the Treasury's cash balance at the Fed, because those were moving in one direction while the balance sheet was moving in the other, all of those components were offsetting each other, and there really was not any meaningful tightening in liquidity conditions, even though the Fed was reining in its balance sheet. So that, you can argue, was a very good outcome. But now the reverse repo program, which is the orange bars, has basically been depleted. So taking a step back, in October of 2023, Janet Yellen at the Treasury made some say a very clever judgment, others say she was tinkering with the system. But when yields were pressing up against 5% back then, the Treasury decided to switch the auction schedule from long dated to T-bills. And that was sort of a backdoor easing move. It was like the Treasury was doing QE, even though it's Treasury and not the Fed, because what happened was, by not issuing long-dated debt, that allowed yields to come down, and by issuing short-dated T-bills, money market funds started buying T-bills instead of using the reverse repo program. And that, again, this is all plumbing of how this stuff works, but that was actually sort of a fiscal, it was stimulative, because one affects bank reserves and one doesn't. So now we are, 5 quarters later, the reverse repo program is all but gone. And if the Fed continues to shrink its balance sheet, it will affect bank reserves. And that would actually, for the first time, be a proper tightening. So we are getting at a point where QT actually could start to matter.
And it could start to bite a little bit. If that were the case, well, let's go into just sort of the desire for the longer dated bonds, because the bond story, as you've noted many times before, the yields being high compete with equities, and there's another equity story. They've got their own stories, but this correlation is been there in good times and bad times over the last 3 to 5 years. But it's a correlation in any case. What do you do with that?
Yeah, so let's go to slide 13. So I think this is one of the big stories in the market. So we know the earnings side is good. We know the valuations are on the high side of historical averages. And we know that we are in for a long fiscal run of fiscal expansion, not just in the US, but everywhere. And we know that after years of quantitative easing and zero interest rate policy, that the term premium, which is the risk premium on long bonds, is still pretty low. So that's the yellow bars there in the chart. It's only, moderately positive, but historically speaking, it's tended to be more positive than that. And that's not a prediction that we're going back up, but I do think it's a risk that a 5% bond yield or even higher could be in our future. And the reason that's important is because if we go to the next chart, bonds are competitive again with stocks. So bonds are supposedly the risk-free asset. So that is the the starting point for an investor, right? So if you have money to invest, you say, okay, I can invest it in treasuries at 4.5, and presumably there's no, at least no credit risk, full faith and credit. There could be an inflation risk, there could be other risks, but that is considered the risk-free asset, and you get 4.5% for a 10-year treasury. Then you go to the stock market. Stocks are trading at 22 times earnings. So that's about a 4.5% yield if you invert the PE. So you're getting the same yield on stocks as on bonds, right? Now, a couple of years ago, when bonds were yielding 1%, and the stock market was yielding 5, like, you're fine, right? If bonds go from 1 to 2, it affects the discounted value of future cash flows, but it doesn't really compete with stocks. But now, as yields have gone up to the level where the stock market is yielding, the so-called Fed model that we've discussed and that was very big back in the 80s becomes in play. And that means that if yields go higher than where they are now, it bites into the valuation of the stock market. It doesn't affect necessarily the earnings or the fundamentals, but the PE of the stock market has to compete with that yield, and that pressure grows higher the higher that yields go. And so again, that that hasn't been the case until the last couple of years, and that's what 2022 kind of ushered in this new era. And that's why you see in the bond market, every time we go above 4.5 and we start approaching 5, the stock market starts to wobble, right? And that is not a coincidence. And that's because there's that pressure. And to show you one more version of that on 15, if you look at the correlation of bonds and stocks, you can see that the correlation becomes positive and more positive the higher yields go. So the horizontal is the long-term treasury yield, the vertical is the 5-year correlation, and the higher the yield goes, again, the more alluring the risk-free asset becomes, the harder the stock market has to work, and the more correlated those two assets become. And so this is just a history lesson on why yields matter. They don't matter most of the time, but there are times when they matter a lot. And I think right now and over the next, let's say 5 years, they're going to matter a lot.
Your last slide took a look at the term premiums, or what will be demanded ultimately to hold some of these assets, but you also wonder what would compete with exactly what you're talking about to to make something uncorrelated? So if you were going to stick with sort of equities, what would you put on the other side to make sure it's not so correlated? An alt.
Yes, and that is and that's the challenge we all have, right? Because the old 60/40 paradigm where all you had to do was own some S&P, at least if you were a US investor, and own some Bloomberg Barclays US aggregate bond index. That's really all you needed. You had the 60, you had the 40. You didn't have to get too clever. You didn't have to go buy gold or go international or anything you did to be very clever about diversifying actually would have detracted from your returns. But that's only been the case for the last couple of decades, and it's no longer the case now. Maybe it becomes the case again. But most investors that are listening, and that, when I count myself in that category, kind of grew up in this 60/40 era. But before the late 90s, we had many decades where that era was upside down, where bonds were correlated. And it's interesting. I don't think we did a show on this, but I'll have to bring the charts in for next week. But I did this deep dive on dollar cost averaging, that if you invest $100 every month for 10 years, and you take you measure at that 10-year point how well you did after inflation, going back 100 years, the batting average is 90% if you're in stocks or if you're in a 60/40. And the times when the 40 didn't deliver were exactly the times when gold did. And so gold is not a great asset most of the time. It only goes up, like 40% of the time, but it's competitive with bonds. And it's competitive at the exact time when bonds are not producing returns. So to answer your question, to me, 60/40 is now, 60/30/10 or 60/20/20. And bonds are still compelling. They do provide a positive real yield. But if they don't diversify, we need to find other things that do. And to me, gold, Bitcoin, alternatives like managed futures, hedged equity, those kinds of pieces, I think they're not negatively correlated. Well, gold actually is, but the other ones are kind of uncorrelated, but they provide the kind of steady returns that bonds used to, but no longer do. So I think we have to just think broader. And to me, it's less about the 60. Maybe it becomes about the 60 at some point just because valuations are where they are and the secular bull market is becoming more mature. But the 60 is a proven compounder over very long periods of history. So it's more the 40 that I think needs to be diversified. And that doesn't mean 0 instead of 40, but it means maybe 30 instead of 40 or 20. And then we sprinkle in other assets.
Switching it up a little bit on the 40 side. Okay, now we'll end off on a note of calm, but I'm just going to ask you a little bit about what's going on. We have no idea about what levels of policy are actually going to hit the ground and actually stick that are being discussed right now. But how closely is the Trump team watching exactly what's going on in the markets right now? I mean, we're led to believe extremely closely and would see some of the risks to even the equity market. And to what extent do you think that is going to guide them?
Yeah, so I think the Trump administration is very focused on on the long end of the yield curve, and the Treasury Secretary, who by all accounts seems to really know what he's doing, they're very focused on keeping long yields down. And so I think so they have the eye on the price, on the right price there, because there are a lot of deficits still to spend. And then, of course, there's tariffs. We don't really know what's going on. I mean, it's tariffs one day, they're extended the next day. How much of this is negotiation? Like we discussed last week, how much is the Canada and Mexico tariffs? How much was that designed to really get Panama to play along on the Panama Canal? Like this is like 4-dimensional chess, right? So you can't react to every impulse because you don't really know where this chess game is going. But obviously there are risks, and the stuff with Doge, whether that creates a recession because of government employees being laid off. I mean, we don't really know the answers. It certainly doesn't seem to be priced in. Um, and so there are a lot of known unknowns, if you will. And it's hard to know what's real and what's not. And so, and that's why we have to kind of stick with the basics. But, this is sort of an all gas, no brakes White House, right? The first administration was like, he didn't expect to get elected. He didn't have anything in place to even get started. So it kind of like got started in a very happenstance way. And he had a lot of moderates in the cabinet, back in 2017, and lots of fallings out, and they all left. And this time it's all loyalist, it's all gas, no brake, and that means that a lot of really good things can happen because it's very decisive, but it also means that a lot of things can break and that they are, overconfident and that they push something without really having enough people in the room to ask the questions about, well, what if that happens? Like, if you don't have that critical thinking, then things can go off the rails. So that's kind of the roller coaster that I think we're on for this year. I think the market has its fingers crossed that we're going to have deregulation, tax cut extensions. We're in an earnings cycle. The tariffs are bluster and negotiation tactics. But at the same time, it's like, if Elon fires, 100,000 government employees who are then filing jobless claims, like what does that do, right? And so, and by the way, we were talking about this earlier, the weekly jobless claims would be kind of the ground zero here for looking at what actually is happening in the government sector with all this Doge stuff going on. Because if those people are laid off, they'll file for jobless claims, and that'll give us a sense of, is the government so big that if people are getting laid off, will it actually cause an economic slowdown or recession? But we don't have the answers to that right now.
So that sounds like one thing. This week there is a lot of eco data due out, a lot of it taking a look at inflation, retail sales as well. But the jobless claims on Thursday, what would you we're going to look at it all, but what would you keep an extra close eye on?
I mean, always it comes down to inflation and employment, right? So obviously the CPI data are important, the PCE data, because that is, again, the CPI went from 9% to 3%, which is good news, of course, at least the rate of inflation. But it's been stuck kind of in the high twos here now for a year. And one of my worries is that if the economy really kind of reaches this escape velocity of animal spirits, before the inflation dragon was fully slayed, then maybe we get another little inflation wave, and then the long-term averages start to go up. If we go back to slide 9, you can see that the 5-year CAGR of inflation is at almost 4%, right? So if the year-over-year rate goes from 1 to 9, it needs to go all the way back below the longer term average to keep that average from going up, right? And so that never happened. So I do think that is one risk. And that, of course, feeds into the shape of the yield curve, into how much the Fed can ease or whether it has to raise rates again, which no one's really expecting. But that's one risk. And then the other side, of course, is the employment mandate. And what does the market do if a bunch of government employees get laid off? Does the market look through that and say, well, the unemployment rate is at 4, the labor market's resilient, there's still some tightness, those people will get redeployed, and like a natural disaster, the market kind of looks through it. We don't know. And of course, the immigration policy is part of that as well, right? So if people are getting deported, maybe there's a swap of, I mean, they're not in the same job market, they're not at the same skill level. So I don't want to make that comparison, but these are things that we haven't really had to think about for a very long time. And so this is all new. And again, it doesn't have to break the market, but when the valuation side is high and the sentiment side is high, you wonder how much margin there is for the market to be able to withstand these headlines. And then to what degree does the good news on the earnings front offset that? So these are all the balls that are in the air, not just for the next few weeks, but probably the whole year.
Probably the whole year, and really, as you say, the short-term impact versus potentially the longer term. Jurrien Timmer, thank you for setting us straight, calming us all down to enter a big week and stick to the knitting and come back to the fundamentals, which you so brilliantly do. Have a great week.
Thank you very much.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.